Good afternoon, ladies and gentlemen. As a part of our CFO-centric webinar series, we are delighted to welcome you to today's session, Decoding the CFO's Dilemma, Sailing Smoothly Through M&A. In this webinar, we will explore the unique challenges CFO faces during M&A transactions in India. Key topics will include strategic financial planning, due diligence, deal structuring, and more. Our panel of industry experts will provide valuable insights and practical strategies to help finance leaders navigate risk, optimize integration, and maximize transaction value, ultimately driving more successful M&A outcomes. Before we begin, I would like to give a brief about Decoding ASA India and our speakers today. Decoding ASA India is the India member firm of Decoding International, the ninth largest accounting network globally. We are a 3-decade-old accounting and consulting firm with a team of over 1,200 professionals across 8 offices in India, supported by a well-established national and international network. We work closely with our clients, including many from overseas, to assist them in setting up offices and factories in India, finding local partners, and addressing their audit, taxation, accounting, business support, GST advisory, risk advisory, and restructuring or liquidation needs. Our esteemed speakers for today are Sushanta Pai, CFO, Matrimony.com. He's the moderator of this session. Sushanta brings over 25 years of rich and varied experience across technology, finance, and advisory domain. His academia credentials include commerce education from Sindham College, Mumbai, and CA from ICAI. His previous stints include Mindtree Limited as the Associate Vice President Finance. Before that, he worked with GE Capital International Services and KPMG. We have Pranav Gupta, Principal Investment Founding Member, Carpedium Capital Partners. Pranav is a seasoned private equity professional with 17 plus years of experience in direct investing, portfolio management, and successful exits. He has overseen the deployment of over USD 200 million in capital across sectors. Pranav is the principal and founding member at Carpedium Capital, which manages USD 120 million investments and has been recognized as one of India's top 40 under 40 investments professionals. He holds an MBA from the London Business School and a BTech from IIT Delhi. Then we have Moksha Bhatt, partner APN Partners. Moksha is a corporate lawyer based in New Delhi, advising domestic and international companies, venture capital, and private equity funds, and senior management on a wide range of issues from formation to liquidity. He specializes in M&A, joint ventures, investments, and corporate disputes, including insolvency and fraud claims. He's one of the co-founder of APN Partners. Our next panelist is Lavanya Pasigia. She's the Chief Executive Officer, Zivame, a visionary leader with over 2 decades of experience in e-commerce, retail, telecom, and IT. She has successfully transformed Zivame into an omni-channel leader with 180 plus exclusive brand outlets and a presence in 4,000 plus trade outlets. With a robust online presence across platforms, Lavanya's expertise in business strategy, financial management, and innovation has positioned Zivame as a front runner in the intimate wear industry. Finally, we have Nitin Arora, Head Transaction Advisory Services, Baker Tilly ASA India LLP. Nitin heads the National Transaction Advisory Team in Baker Tilly ASA India with expertise in M&A, private equity placement, financial due diligence, business valuation, and cross-border transactions. He has led numerous buy and sell side deals across various sectors, specializing in end-to-end investment advisories. A chartered accountant with a commerce background, Nitin is a former board member of M&A Worldwide, a global network of mid-market investment firm. Before we begin with this engaging session, few pointers for the webinar. Please note that all participants will be in listen to only mode throughout the webinar. If you have any questions or comments, please feel free to put them in a question section in the chat box. Thank you, everyone. Over to you, Sushant.
Thanks, Manisha, and thanks, ASA, for this platform. And thank you all the panelists and all the audience who have joined for this session. I just thought I'll just start with a little bit of numbers. And obviously, when we talk about M&A, right, the numbers are very large. But since this is an M&A session, in India, 9 months 2024, I think there was about 2,300 plus deals in M&A, which is approximately, I think, about close to $69 billion. And if you compare the same 9 months of last year, 2023 actually, slowed down. M&A actually slowed down. And that number is about 1,800 deals, with a $60 billion sort of value. So M&As have increased, if you see year on year, by about 14%. So what does this mean, right? M&A is a strategy for all companies, whether big and small. Like, for example, Matrimony, our size is only about close to 500 crores at the total income level, but M&A remains a strategy even for a company like us. So it's an important driver of growth. Having said that, we all know, on the other hand, maybe 70-80% of M&As also fail. And I think that's where that metric can be improved a lot. And the driver for that metric, or the influence for that metric, I think CFOs play a very large role there. And that leads me to my first question, is that if you have a very good CEO CFO partnership, right, M&As can work very well, because both entities see it one from very different angles, right? Business sees it from a very different angle. The CFO sees it from a different angle. There is no right or wrong, but CFOs play a very important role to minimize the risk. Obviously you cannot take out the risk completely. You cannot be totally risk averse, but I think CFOs play an important role there. So my first question is to Lavanya, saying that how does this work? Can actually CFOs get into the deal very early on along with the CEO? How does a CFO say no to a deal, right? Does it actually work? How much influence does a CFO have? And what can CFOs do to create that balance, saying that, whether one will work or not work? Because I want to also talk about an important aspect here called the opportunity cost, right? For example, if you do a deal now and 2 months later an interesting deal comes, you may not be able to do that because there's no unlimited resources. So how does this work? And, if you can provide some thoughts on this.
Yeah. Thanks, Sushant. Thanks, ASA, for giving this opportunity to share my thoughts out here. Just to set the context, well, today I'm doing the CEO role more in a more a business front. Not a few years before, I was actually the CFO for Zivame. I actually had the strategic exit for Zivame when we got acquired by Reliance. Okay, so obviously I had the opportunity to work with the CEO very closely throughout the deal. When we did the fundraising. So I have done fundraising very closely before we kind of had a strategic exit with Reliance. Gone are the days where I think so the CFO is considered, say, probably as as a more as a function. They are today more as a business partner, right? At least the CEOs whom I work with, or even the how I work with our CFOs, that they are obviously there in the forefront when we are considering any large business decisions. We also understand finance guys put the spoke in the wheel. They come at the end and then they say there is a tax issue, or there is a, say the optimized cost what you're looking at is not going to work. So the business is also today partner with finance much early than how it was, say, probably, a couple of decades back, where they were just looked at more for execution, right? So today, I think so the CFOs understand the business also much more closer. So they obviously have that seat on the table to work along with CEO on any business decisions, and M&A is no different to that. While say the CEO, the founder, has a vision on how the company should propel to growth, and then we kind of achieve that growth or that milestone either organically or inorganically. So when it comes to an inorganic growth, and we kind of define M&A, so the objective of it obviously has to be clearly defined, and which is what the CEO defines, saying that this is the strategic vision what I have for myself. By doing this M&A, we're going to reach into this level by such and such this, or it gives us a product advantage, or it gives us a patent. There can be a reason for what we are doing it. Obviously, the responsibility of CFO first is to get that executed, right? In terms of how do we get it executed? So you actually look at obviously the financial aspect to kind of get it executed. So whether you have the funds to do that M&A, that's what the CFOs definitely looked at it from. So there comes the risk and the opportunity. So if I'm going to block my funds for this inorganic acquisition, what I'm going to do, what are the things it is going to kind of put the stress back into the system by doing this deal? Do I have the risk appetite today to execute this deal? Becomes very, very important, right? So so as long as the CFO is clear and gives the comfort to CEO, saying that this is well within the risk appetite, or this is the risk we are taking and these are the ways that risk will be mitigated. The second is the advantages what we are perceiving, say probably from a market size perspective. I'm just giving an hypothetical example. When you do a deal, you actually think that you're capturing a certain market, but when you actually run the numbers, probably it is not translating into capturing that market, so kind of finally translating it into numbers to say that, hey, I don't think so. The assumptions basis which the M&A is set is being achieved or not being achieved is another way when the CFO can kind of tell no to an M&A deal. The third big option is obviously if there are any non-regulatory or a non-regulatory compliances or non-compliances, which is going to give exposure to our existing businesses through that. I think so that is something which only finance folks or the legal folks have visibility into and can kind of say there is a risk in kind of doing this M&A. So I think so being a risk bearer or the conscience keeper for the company, only when he or she sees that as detrimental to the existing position of the company or for the growth what is planned, I think so those are the only times when we kind of see CFOs really saying no to the deal. Okay. Yeah.
So thanks, Lavanya. I think one of the best practice I learned, from the board is that typically, we always want to put a list of things that we want to do, right? And one of the key learnings I had was put a list of things you don't want to do. That brings in a lot of discipline for the organization, right? It's a very different way of thinking because everything in a toy store looks interesting. But if you say that even if a deal is interesting, but these are the areas I will not do, that itself will bring in a lot of discipline. And that's one thing I learned from the board over a period of time. Thanks, Lavanya. The next, the question is related that, okay, you get into the deal now. And obviously, that when you do a due diligence, right, there could be deal breakers, right? And some deal breakers, you cannot solve it. However, some can be ring fenced. For example, if there is an issue you're not clear about, you can always keep some consideration as a contingent consideration and move on. Just wanted to get some thoughts from few panel members here. We can start with Moksha. What do you feel about it? What are, according to you, some deal breakers that can be solved and some that cannot be solved?
Thanks, Sushant, for that question. And I sort of will go back to the very interesting points both Lavanya and you made, which is essentially M&A and the diligence exercise, especially, is a part of the risk management exercise that you undertake, right? Because whenever you are seized with an opportunity, when an opportunity comes to a business to say, look, here is what we can achieve by acquiring this company, it's a heady moment. There's a lot of excitement. And in that moment, there is a need to sort of pause and do an exercise in risk management, allocation, and mitigation. And that essentially is what the diligence is. From my perspective, the key idea here is that most commercial risks can be managed in one way or the other. You can have holdbacks, you can have earnouts, you can have indemnities. You have a range of solutions that you can do. What you can't solve for is actually trust, in terms of did you do the job well, or reputation. The real challenge that most businesses that I have seen, especially in a go-go M&A environment where a lot is happening, is that sometimes there is a tendency or a temptation to move very quickly. And what that can sometimes do is leave open the exposure of did you think it through? And that sort of links to what you were saying, Sushant, in terms of what do you not want to do? What you don't want to do is essentially be found to have not thought things through and thought of the downside risks. So that I think is a central idea. The second central idea that I want to just flag for the group is essentially, at least in the Indian context, information is imperfect, and that's something that we need to be acutely aware of when you're doing a diligence. Even if the founders or whoever you're acquiring wants to give you the information, they may not necessarily have it. Because that's just how it is, and even in the best run companies. So that's something to be very, very mindful of. Personally, I've seen very few deals that fall through simply on account of a diligence. But I'll just narrate an incident, which is, I was speaking to Sanjeev Bikhchandani, who's a storied investor, and he said a diligence is a time to also evaluate how a founder is behaving, not just how his company is. And that I have seen in a few instances has been more a reason for why a deal has fallen through and not gone through. The last point I want to make right now is from a seller's or a founder's perspective. And very often in a diligence, there is a worry of should I tell the investors this? And it takes some level of education in telling them that, look, actually, you should be very candid about whatever is happening. And that candidness is what will give you protection tomorrow if there is a claim against you. So be upfront and be clear about what it is, because ultimately it is an exercise in risk identification, and there is nothing to be gained by not being as candid as you can. So that's largely what I'll say.
Thanks, Moksha. Very, very interesting points. And since Nitin, you're from the other side, I know we've got the legal side of it, from the financial side. The same question, what are some deal breakers you have seen? What are some things you can ring fence?
Sure, Sushant. So, from a financial and tax due diligence side, primarily we categorize issues into two buckets. One is called the pricing and negotiation issues, and one is called the protection structuring issues. So, as the name suggests, pricing negotiation issues have the impact on the pricing itself. And for example, if you need to adjust the valuation, those are the pricing issues. And protection structuring issues are issues where you need to protect yourself against the risk, primarily, unforeseen tax litigation, any legal issues. So, and when pricing and negotiation issue also two types. One is which have a one-time impact. For example, if your inventories, old inventories are, kind of bad, you just do a one-time adjustment. But more dangerous are those which have a, let's say, 9-time EBITDA, 8-time EBITDA impact. For example, if you have one-off cost, one-off revenues which are not accounted for, then the impact on the agreed valuation is much more. So how do typically we, or in that, because I've done diligences, as part of my career with EY, and now I'm doing deals. So it's sometimes very interesting to see how do you take care of these issues and not let them become a deal breaker. I think that was your question. So on the pricing and structuring issue, it's primarily easy. You do a renegotiation of price, or if something is linked to future, like for example, if it's something is linked to a future performance, you do a earn-out mechanism or adjust it in the second tranche. Worst case, you can put some money in an escrow and say, okay, if these milestones are achieved, we will release these payments to you. When it comes to the protection structuring issues, there the mitigation depends on the level of risk which a buyer perceives. And I think it's more Moksha area. But for example, what we have seen is that if the lower the risk, we take reps and warranties. The risk go a little higher, you go to the specific indemnities. And if the risk is very high, then you put some money in an escrow or do a holdback. But if you honestly ask me, Sushant, about deal breaker, I fully agree with Moksh. I have seen very few issues from due diligence becoming a deal breaker. But unless and until something impacts the fundamental reason for doing a transaction. And I'll give you an example. We just concluded a deal in Bangalore 2 weeks back. The Schneider was one of the client which was doing 60 to 70% of business. Now the buyer said everything is nice, everything is okay, but till the time Schneider gives me a consent, I'm not going to do this deal. So unless and until those fundamental issues get, or let's say promoter credibility is not found in a background check, For example, in a listed transaction we are doing, the market price is much higher than the kind of the negotiated price. So there is a SEBI regulation which kicks in. So unless you have issues of that magnitude, which becomes a deal breaker, most of the deal issues get resolved either through a documentation security or through the renegotiation.
Thanks, Nitin. Pranav, would you want to add anything on this?
Yeah, sure. First of all, thanks ASA for providing this opportunity to join a distinguished panel here, and thanks to the audience for coming over for this panel discussion. So, very pertinent points made by Moksh as well as Nitin here. And I'll just bring in a perspective, drawing in from my experience as an investor, wherein I've been overseeing diligence to lead a transaction at times on behalf of a portfolio company to its conclusion of getting acquired or actually making an investment. So what I've seen is that a red flag can be, the financial discrepancies a diligence may start throwing up. And if we were to kind of dissect it in terms of why it would have potentially kind of arisen at the first place, one can be there are inaccuracies in the data that was being narrated and maybe what is being now retrieved from the records. Now, that is a very prelim and basic sort of stuff that can happen. But other interesting thing that I have come across is, there are inconsistencies in what the diligence is actually telling us and what the narrative has been, basis a fractured relationship between the CFOs and say the diligence providers themselves. So in my view, it's key that if you look at this role of a CFO at various organizations, at times one can be inward looking, and there are other ways to approach it. It's more outward facing, wherein the intent is to collaborate with the diligence team instead of doing bare minimum to get through this process of diligence. So it is in those moments wherein there is an opportunity really to not only have this process be seen through, but also collaborate and steer the partners in the diligence team, the CEOs on the respective sides of the table towards a singular direction of how data has to be looked at. In fact, when that does not happen, it typically leads to, as I said, a fractured relationship between, a diligence team is sitting in a silo and trying to retrieve the data information from the company, and the company itself is just waiting to hear back from the diligence team if there are any more questions. But that bridging is really key in terms of building out a relationship here. And I at times feel that CFO really has that opportunity to understand that this is a more extensive process, the diligence, and it's not akin to say an annual audit process that you are trying to just get done with and you've seen it through and through. And any acquirer or investor will tend to lean on this diligence to build their business understanding, gain comfort, as one of the panelists rightly said, that it's actually also an assessment of the team, not only the CEO, but also the finance team. And if it starts, there are cracks that starts showing up, the assessment may be that post investment or post acquisition, this team needs to be made more robust in terms of their constitution. So I think, as a panelist rightly said, it may not necessarily lead to a deal-breaking situation, but it kind of sets a not so desirable stage for the diligence to be carried out further, and there have to be amends to be made on both sides of the diligence team as well as on the company side with the CFO for this to then come together, provide a singular message going into the acquirer or the investor, and conclude the process. So yeah, that's something I'll add.
Thanks, Pranav. So once we are moving now in the M&A process, and finally you need to fix a price. Valuation becomes key, and valuation is very judgmental, right? Because you've seen the valuation field because of the startups coming in as well. So wanted some thoughts maybe from Nitin, saying that how do you deal with valuations, because it's very judgmental. There is on one side startup valuations, on the other side there could be a traditional company valuation. Where do you put all this together? How do you know that you're not overpaying for a particular company?
That's, I think, the most difficult part, Sushant, because you rightly said it's an art. It's an art because there's no right and wrong answer to it. But let me start with little fundamentals to evaluation. So when we start doing evaluation, there are primarily three methods to do evaluation: book value, your comparable companies, and the future-based DCF valuation. Now, for startups, of course, the book values don't apply. Even sometimes multiples don't apply. But since we're talking more on startups, I think, Kashran, it also depends on where the stage of startup. So, for example, for an angel and VC, I have always seen, and maybe Pranav can also comment on that. It's sometimes more gut feel. Okay, for $1 million, I want to take 20% or 25%, 2 million, 30%. There's very little science going into it. It's more of a risk appetite of the both the investor and the this thing. But as the startups start going to a pre-stage A and little growth, then your business plans, your the ARRs, what is the annual revenue, because that time also most of the startups are not profitable, so we don't use the multiples on EBITDAs. So we'll say, okay, what is the revenue multiple other companies are kind of getting, and we apply those kinds of multiple. It's when the companies reach the mature stage to likes of Nykaa, Zomato, Swiggy got listed, so then you have much more established benchmarks, whether domestic or globally, the peer set, to say, okay, that's the multiple being derived by these kind of things. But to be very honest with you, Sushant, or sometimes it's also the factor of demand supply. If there is more money chasing very less companies, the valuations tend to be very high, and when there is a funding winters, the best of the companies do not get valuation. Now, to answer your question, whether it is right or wrong, one needs to, devil lies in the details. So if somebody says, you're paying 5x of revenue, but unless and until you go into the detail and see what it translates, because startups typically get valued on future. So when you factor in the future, the full scale impact, then numbers start making more logical sense. So, when Zomato got listed and the way Zomato then acquired Blinkit, and today where what Zomato is, it has a journey where numbers start making more sense over a very long period of time. So to say, in hindsight only, you can say you have paid more or less, but ultimately you need to have a very thorough assessment of their business plan and a conviction on the founder to say that whether this guy can execute or not, to decide whether you're paying the right price or not. That's my view on.
Thanks, Nitin. We'll come back to Lavanya. There are two parts to this question, right? When I first alluded to a lot of M&As fail is because of mainly two things. One, we are not able to integrate the entrepreneurs, right? Because when we acquire a company, typically they are entrepreneurs, and once they come into our fold, into the acquiring company, is that they have some views and suddenly something doesn't go well. For example, a lot of times I see entrepreneurs wait till the consideration, contingent consideration or the deferred consideration is received, and they just move on. Somehow I'm seeing that they don't see enough value once the acquisition is done, right? They're not seeing the long-term view of the combined entity. So that is one. How do you deal with it? What are ways to engage the entrepreneur? The second part of the question is integration itself, right? What are some things that we need to do well to make sure finally the company integration of the company is successful? So one is from an entrepreneur angle, and one is from the integration of the whole company itself.
So Sushant, coming first to the the founder as such, the entrepreneur or the founder of the companies. Typically, founders come with so their focus is obviously identification of a problem, what is there, and how they are going to kind of solve the problem through the proposal, through their the services or the product or whatever we are offering, right? Let me talk about just talk about Zivame. So Zivame, when we started, we just wanted to solve this poor shopping experience when it comes to lingerie shopping in India. Was the was the goal statement for us to solve, saying that, the lingerie shopping experience is not great. How do we improve upon that? So during that journey, obviously you kind of realized that, there is a product gap, there is a channel gap, the communication gap, there is no education around that sector and all that. So what happens for a lot of times, for founder, it is more of the vision, what they have created for the brand, right? What is that brand has to do? Okay. A lot of times, post M&A, and obviously our founders have exited at this point of time. Post M&A, also, it's about whether how is the combined vision set out it. If you are focused on continuing that brand journey, but there might be a reason that the M&A where they want to actually get into a prominent position within the category itself. The acquiring company wants to get into a prominent position, wants to do a larger market, or they would have acquired companies in the same space, which is what Reliance has done. They have acquired us, they have acquired Amante, Clovia. So they wanted to create a very prominent position within the same sector, and make themselves as market leaders in that position. So obviously in that event, the initial onset of what you wanted to do with the brand kind of changes. And at that time, since there is always once that there is a change, there is an exit, what they want to kind of look at from. Also, a lot of times it's mutually agreed also, where founders are given an exit path post a certain number of years. And once an entrepreneur, always an entrepreneur. So also this is something which I see, where the entrepreneurs want to keep on building newer companies, solving newer problems. So the so-called where you are trying to do a lot more stuff at the same time, or where you're not like bound by so much processes. So as I have worked in startup and obviously worked in much more matured companies, I think so here it is all about one single goal. In a startup, it's about one single goal, everybody's trying to achieve it, not so much of a defined process, procedures around it. Like you're okay to take calls and quickly fail. So one is setting expectations really clearly at the beginning of the deal. What is expected out from each of the parties, both the acquirer and the acquiree. What is expected? How is the brand going to promote? How is the larger vision of the brand going to be there? Once all those communications, timelines of integration, I think so the cultural integration is obviously the biggest thing, which I have seen people kind of either stay or leave, is about whether that the vision what they set up for the company continues to exist. And that's probably the meeting or the breaking point, what I have kind of seen, because most of the times founders are very emotional about what they have created. So about clear setting expectation, and taking that company forward in the direction what was set by the founder, would be one of the reasons for them to continue to stay in the game, apart from obviously valuations, the exit route and all that, which is kind of planned.
So the one thought that came to my mind is a few years back, I was running an integration agenda for one of the acquired companies. One thing that really went well is that when the org rallies around this as one of the key things to be done for that year, right, it really goes well. So for example, we set up a theme for one of the companies when we acquired called, we just gave it a name, and I remember that name, it was called Energize, Synergize. Because I think finally an M&A succeeds because you need to create energy, right? It is not like, it is not a segment like others, right? It is part of you, so you have to create the energy. And the other name was given as synergy, right? Why you want to do an acquisition is because it has to be large, it has to be synergistic, right? So sometimes I felt that when you rally around the cause, right, the M&A and the integration becomes more successful. Moksha, any thoughts on this? Any further thoughts on this particular angle of entrepreneurs? How do you keep them engaged?
Sure, absolutely. And I would largely echo what Lavanya said, because I think that makes sense. Founders are passionate people, and they are looking for challenges, and to keep them engaged is not so easy. And certainly, you need strategic clarity upfront. What I've seen is, how do you actually do it, right? So it's one thing to say, I want you to stay engaged, but legally, what are the strategies that I have seen that work? The one strategy that I think clearly works well is having earnouts or some sort of an economic incentive that links to the future, the business doing well in the future. So I think that's one idea that does well, but it's a bit of a mixed bag because you have to be very careful in how you structure that earnout. So I'll give you a few examples so that you understand, right? So let's say, for example, a founder's uh, subsequent earnout or performance incentive is linked to future revenues or future margins. The business is then not necessarily fully within his control. So overall objectives evolve over time. So you may have decided initially that you're going to go for growth, but at some stage there is a business decision that you need to, improve margins, for example. So those are the sorts of things that can create challenges. So it's very good to be upfront and clear right at the beginning. So there is also often, when you're sort of trying to integrate a business, a desire to paper over differences sometimes. So, for example, you'll say that, broadly it should be this, but rest we will mutually agree. Those sorts of things create challenges because, when you actually get to that situation, there is actually sometimes no deal because you may have agreed to situation X, but actually nobody has thought of situation Y. So what is important for both sides, founders and for the acquiring business, to think of upsides, yes, but also downsides, and clearly document them so that everybody understands what they're going into very, very clearly. So, for example, let's say you have a founder and you've taken them on board, and to Lavanya's point, there is no value alignment, and actually there is a need to pathways. Have you clearly documented a path for yourself to either take over the business or to exit, depending on who it is? Sometimes it is not so clear, and very often these situations then get a bit messy. So it's better to have a hard conversation upfront rather than to try to paper over differences. Would be my thought here.
Sure. Oh, just one point I would like to add, also from my experience, is I think sometimes what we do with the founders coming in is that uh, sometimes we impose on them, right? It's always, the bigger company mindset, and we think we know everything. But my view is always that if we have acquired the company, which means they are better experts. Therefore, I would prefer that you give them a boundary. For example, when I mean a boundary, is that broadly, this is the resources you'll get. This is broadly, the revenue which you can potentially earn, and you keep the profits or losses within a boundary. So then what happens? I think the entrepreneur has a playground. He knows the he or she knows the boundaries, and you allow them to play. I think sometimes the mistake we make also is that we want to set the fielders, right? So I think that's where sometimes we go wrong. Thanks, Moksha, for it. And Pranav, since it's an important topic, we'll take views from your angle as well on this part.
Sure. I think again, building upon what Moksha said, and on identifying and be very clear about why are we going ahead with this acquisition at the outset and have those tough discussions. So, question to ask oneself will be whether the acquisition is being made to allow for the target to operate with autonomy, or is the expectation that the acquirer will either absorb the business in in its own operation, in its own business, or in a way, at times acquisitions are also made to kill eventually the target business, so to say. So to um, to not really I mean, it's more to kind of capture the market share at times. So let me give an example. Zomato acquiring Blinkit, there is a clear mandate there that Blinkit is operating with some autonomy. Zomato acquiring Uber Eats at one point in time, which was clearly an acquisition done with a different intent. So if that intent is clear at the outset, discussions internally can be had on what will be the path to path forward. If it is going to be absorbed in the primary business, then you know that you're talking about a transitionary phase for the business that is being acquired. So in a way, I think again, I feel that there is an opportunity wherein, given that there is an acknowledgement that we also heard from the panelists before, that there is a distinct cultural and ethos which are very separate from for the acquirer and the target company. The professionals that now are dealing perhaps with entrepreneurs directly, which are different kind of creatures in themselves, as Lavrin had put it. They're a bit more emotional or passionate about what they built out, strong identities coming from varied backgrounds, and decision making at their level has typically been fast. It's not been as process driven or with some kind of reaching out to someone to take consent, etc., and to actually effect some operational decision or strategic decision at their end. So that's the kind of cultural shock they usually get in with. And then finally, at times these incoming teams from the target company may also create some insecurity in some other teams at the level of the acquirer company itself. So if you look at what's really happening when you're getting in a new company and which is supposed to operate within that fold, there are these acknowledgements that hopefully are there, and hence there has to be some mitigation strategies that are to be devised at the outset, to understand that we need to invest enough time to preempt and deploy these mitigation strategies to, for example, de-escalate some potential tensions that can brew up as you move forward between the competing teams, or to bring the incoming team up to speed of how what's, say, in case say Zomato, what's our style of working or what's our way of working. So while I'm not saying it's completely gonna switch, but there has to be some bridging there that has to happen so that everybody can work in a more synchronized fashion. So, and there is a fundamental need to feel respected to and secure to some degree in any role as this transition happens. So I think the playbook for this is not get developed, to that extent, and integration remains a challenge for most of the M&As.
Sure. Thanks, Pranav. So we are also seeing, a slew of SME IPOs, right? And the question in my mind is, are they the preferred route over strategic investments or strategic investors? Nitin, this question is for you.
Sushant, in my view, I don't know if others agree or not. These are two mutually exclusive things to a very large extent, because the target audience for both is quite different. The transaction we were doing, the promoter was chased by many merchant bankers for a better valuation on a S&P IPO. But since there was a clear succession planning issue, he wanted to exit. So even at a multiples which are for pricing or the valuation which was lower than the SME IPO, we decided to go for an M&A transaction. So, if you are looking for a growth capital, and if you're looking for a growth capital with less intervention, and with all due respect to my friend Pranav, but let's say with private equity on board, there is some level of accountability. You still have to be private equity. So if you're looking at growth capital with less amount of interference, then maybe the SME IPO route is a good option, because it's the regulations are still not as strict as the main board. Although it has its flip side also, and we have been reading about all these valuation issues which are coming in SME IPO, and SEBI getting stronger and stronger. The famous case of Resourceful, where one Honda, that a franchisee had a multiple of what kind of a valuation they got. But still, to say that if it's a clean SME IPO, it's a good way to get growth capital. But if you're looking at either an exit, or if you're looking at some technology from a partner cross-border, or you're looking at international markets, SME IPO doesn't solve. It does solve only the problem of money. It doesn't solve any other thing. Neither liquidity to a large extent. So I think the target audience is different. And if you're looking for strategic M&A, then the objective is completely different than when you go for an SME IPO, or for that matter, any IPO actually.
Thanks, Nitin. So one of the things,
So,
right?
so Sushant, I just want to add one thing to SME IPO to what Nitin said. Okay, see, IPO as such, in an SME environment is very, very difficult and probably even very distractive for the company on an overall. Okay, like IPO itself is like the whole organization is going to kind of work on what is the valuation you're going to get, what is the numbers you're going to do. I think so in an SME setup they're not even like prepared or to say that you are going to get questioned every quarter about the results and your fluctuation is going to happen. There is an external governance which is going to kind of come in an SME. They're not even prepared for something like that, so an SME, they need to be doubly sure that they want to go the IPO route. Actually at a scale an IPO makes more sense than SME is my thought.
Sure. Thanks, Lavanya. So one of the things is that if an M&A goes bad, right, you get into disputes. So this question is for Moksh, is that what are the typical disputes that arise in an M&A, and how can you prevent it at the contract stage itself?
Sure. And so thanks. The the basic idea here is that all documents look great until something goes wrong, and it's only then that you find out what had happened. And then there are learnings as you go through that process. So let's talk about the world that we live in, right? So the world that we live in is where there is a greater tendency for acquirers to have or to use templatized drafts, right? So there is, market standard is the word that you would often use. And there are terms which are used very often. For example, if there is a put option or if there is a drag, etc., which have come in and are, frequently used in commercial deals. The challenge that we need to be mindful of is that in many ways, this is still a jurisdiction where things are evolving, and there isn't a lot of precedent of things actually being enforced. So it's only when you go through that process that you realize that even though there is market standard and everybody writes these things, that implementing these things is actually very, very hard. So that's just something that is the reality of the M&A environment in India. So that's generally the comment that I will make. So that there is very little stress testing on some of these ideas.
Sure. So
The other
basically, you're saying it is long drawn. Whatever you do, it can be long drawn if it's a dispute, right? That's what.
So it is long run. B, there should be generally a focus on keeping things simple because complex things will again not have precedent. So while it is good to have innovative solutions, try to stick to what is stress tested. So stress testing is the element that one should be mindful of. And of course, there is room for creativity, but we should just be mindful or recognizing what's the risk that we're taking when we're going with a creative solution as opposed to what has greater legal standing. So that's one, just from a legal standpoint.
Yeah.
Broadly, there is a lot of issues that come from that earlier point that I was making, which is the tendency in an M&A deal when you're across the table to paper over differences. For example, if there is a valuation mismatch, there may be some language that, we will appoint a third party valuer, but there will be no framework on how that guy will be appointed if we disagree. So that immediately takes you to a point where the deal is then at a crossroads where you don't know what will happen because you don't know how a judge or an arbitrator will respond. Broadly, in terms of the kinds of disputes you come, and I'll just spend a minute on this. There are two types of things that happen in an M&A deal. One, you find out something that was not told to you, right? Which is post-acquisition discovery of something. The way you address it is by having suitable or broad reps and warranties in your agreement. And the fact is that this sort of links to what I was saying earlier is that there is information asymmetry, that this is that market. So you need to have broad reps and warranties generally. So that's how you address for it. And of course, covered by indemnities. The other piece, which often comes up in acquisitions, especially in staggered acquisition, which tends to be the flavor of the day, is there is a change in circumstances. You had decided that you will buy this company for X reason, and the reason does not pan out, the relationship does not pan out, or the environment changes. What do you do in that situation? Because your agreement will say something else, but your intention at that stage is something else. And very often, then people start looking for issues then to try to, sort of reverse engineer a default or a breach or something of that sort. So it is in those situations that clarity in the documentations help and avoids dispute. So principally, hard time or hard effort earlier is better than being in a situation where, people are fighting later because there's an ambiguous document.
Thanks, Moksha. Interesting conversations. Since we have about 10 minutes left, we'll take some questions from the audience. So, Manisha, do they just need to ask questions from here? Do they just raise their hand? How does that work? Okay, we'll just. I have got some questions from the audience, but I'll just wait for a minute or so to see if somebody is asking questions on this.
And you have to ask questions. I'll just start with the first question we have received from the audience that when managing multiple stakeholders such as
Yeah, I have that,
shareholders,
Manisha.
investors,
I was more. I'll do that. I was just checking if somebody wants to ask a question live. There's nothing like
no,
that.
these are the live questions that I have shared with you.
Okay, fine. I'll take it. So one is there's one question which says that when managing multiple stakeholders, that is shareholder, seller, buyer, investors, etc., how do you ensure alignment and prevent disagreements over the deal's direction? I'll just open it to the panelists. Maybe Moksha can look at it or anyone else. Yeah. We cannot hear you.
You're
I'm bad,
mute,
sorry.
I think.
Sorry, my bad. So, and this happens almost in every deal, right? That you within an organization have a deal champion, somebody in corp dev or whoever who sourced the deal is very invested, has engaged with the founders. And then there are others who are less enthusiastic, right? So within every organization, and it's not a bad thing, right? Because you need to have champions and you do need to have people who question the deal. So there are, in that sense, wheels within wheels. I think what's important in each of these situations is to make sure that there is a high degree of communication so that at least there is internal alignment as you move forward. And if you don't have that alignment, then you should be thinking very deeply about whether you're doing that deal or not, is what I will say. And that this sort of links to the tension very often that you have between finance, which is looking at risk, and business, which is looking at the opportunity. And that's the dialogue, which I think is very constructive, actually.
Understood. So the next question, this maybe Lavanya could answer, is what would be your advice for CFOs on managing cultural integration between two organizations to ensure a smooth transition? Your advice for CFOs.
So I think so. This is something which we have gone through. See, obviously, one is understanding. So where the real culture differences, apart from is how is the processes what you have, the policies what you have, right? It can be as simple as like in a larger organization. For the last employee, it can be is my travel and employment, like is that kind of aligned. So if you can get consistency among the policies, these are our policies, these are what we kind of stand for, these are non-compromisable, these are some things which is probably better when you move into a larger organization, which is what we have kind of seen. And how that gets communicated, saying that starting this financial year, these will be the new policies, what is kind of which will be do. Approval, this is the approval metrics which we will kind of follow. These are the newer set of guidelines what we do. I think so culturally, as long as you kind of say this is the new way of working and these are the advantages what we see in these new way of workings, and give a positive twist. It's also about it's also about perception and how you set it up. If you're going to say no, this is not working, what we are doing, we were doing better off there, I think so that creates a rift, and the people never kind of settle down. I feel as long as you say, communicate very clearly with the teams, say that this is the new way of working, these are the things what we'll do, nothing changes, but these are the small changes what we need to do post this M&A. I think so those things help in culturally integrating the teams much better.
Got it. this question may be for Nitin, is that what are the key regulatory hurdles, issues companies face in cross-border M&A transactions? How do you prepare for such regulatory scrutiny?
Sushant, I think from regulatory, there are two parts. One is on the FDI side of it. So if you're looking at a transaction in a sector where there's an FDI restriction, probably you have to look at it. What is the FDI requirement? So for example, some sectors are still, most of the sectors have been opened up for 100% FDI, but there are some sectors in which still there is a 74 or there's a regulation. So I think that's one important this thing. The other basic thing is on the valuation. Now, in fact, there's a very interesting situation in the cross-border. There is a SEBI requirement or actually it's a FEMA requirement that the transaction has to happen at a fair value, above a fair value if you're selling a share to a non-resident shareholder. So there was a Japanese client we were dealing with many years back. They said, the target has informed us that only DCF can be used because that's the FEMA requirement. So one needs to be aware of what exactly is the regulation. We need to have a proper consultant to guide you because that's a regulation, but that also is to stress test the commercially negotiated price. It's not that the FEMA valuation, of course, needs to be taken care of, but that's not the benchmark in which you start the negotiation on a pricing. So I think these are few examples or nuances, especially in a cross-border, I'm saying, where you need to have a proper advice while you are getting into a new territory.
Thanks, Nitin. The next one is saying, is high employee turnover treated as a red flag during due diligence? Maybe Nitin, or anyone else? Yeah.
Okay, I'll take a shot at it and maybe others can. So high employee turnover is actually, again, depends what is, again, you're benchmarking with. So if you're working in a startup, there is anyways a very high attrition. IT has a different kind of an attrition, but if you're working in a manufacturing company, let's say 5% attrition. So we definitely, as a part of our HR diligence, when I say HR, means financial portion of the HR diligence, we definitely look at attrition. But to be very honest with you, unless and until we believe, actually, it's more on the KMP. People living at the lower end, even if there's a churn and there is a logical explanation, doesn't create a big issue. But if your CFO, CHRO, CEO, all these people have a tendency, then of course it's a red flag to understand what has been the issue. So I think it depends on each situation. Maybe if somebody else wishes to add, yeah, I think Moksha or Lavanya.
Maybe Lavanya can go if she wants to.
Yeah, so I think so. It depends on the size of the company and how, the risk is divided. But at least in a startup scenario, like he said, if the KMP, there is an exit of KMP, then obviously the value proposition, what they offer to becomes very difficult to maintain, which obviously creates a revenue risk, how they're going to kind of deliver the revenue based on which the valuations are done. So I think so KMP is, if there are too much exits at KMP, it's definitely a red flag in a startup ecosystem.
The only point I have to add over there, sorry, is essentially, my apologies, is this is something to actually pick up as a part of the diligence process, which is do management interviews. So that's sometimes something that can be very helpful in understanding internal dynamics within the company that you're acquiring.
Understood. Yeah.
And I'll just add here that anything which is deviating from what is considered as business as usual, that ought to get highlighted, and the target should actually take a more open up kind of a stance in terms of sharing that data and explaining to the acquirer or the investor, why what's driving this trend which is away from business as usual. It'll create more trust. It's an opportunity, and also devise what are the rightful strategies going forward.
Got it. Thanks. It was a very interesting and insightful conversation so far. Let me maybe try to summarize this whole thing. So we started with the most important thing, the CFO CEO relationship. So basically, we said there that if the CFOs get into M&A quicker, it is not only at the valuation stage or whatever, more even at the stage of market size, assumptions, all of that, it will help in the whole deal process. Lavanya brought out saying that non-compliances play an important part, whether it is a deal breaker and whether the CFO should say no, that sort of a thing. And reputation risk is also a big thing, for a deal breaker. So that's more on the mostly on the CFO CEO relationship. We moved on to the DD. I think they're pretty much manageable. I think nothing much came out saying that typically DD has red flags, which you can manage in terms of various mechanics like contingent consideration or adjustment to cost and all of those things, not typically deal breaker, and that's more which comes outside the DD sort of a level. Then we looked at what is a good price to pay. And I think one of the factors that Nitin brought out was, the business plan assumptions become very important in the whole pricing and valuation strategy. We touched upon an important topic on entrepreneurs. I think the key reason why entrepreneurs don't stay for long, because they are entrepreneurs. That's the key reason. They want to solve problems. They want to start new things. So if companies maybe can find ways to create that entrepreneurship within the company, for example, if the company wants to start something new rather than they running their old business, give them the shift to something, that will help. And we also spoke about documentation is important when you have an entrepreneur, autonomy, for example, and all of that. And we also spoke about overall company integration, where having a team, the culture, engaging for better decision making, all that helps in integration. We also touched upon the SME IPOs. I think broadly, there is no right or wrong answer. Nitin just mentioned that if you want to have growth capital and with less influence or interference, then IPO is better. But obviously, IPO has its own distractions, in terms of that. And finally, about disputes. The end result is you can have whatever clauses you want, indemnity, reps and warranties, creative solutions, all of that. It's important to have a framework, not just a statement, but how to do those things. I think framework is important. And, and whatever clauses you put, finally disputes are very long drawn process. So you have to be careful about it. It takes its own time. So that's, broadly to summarize this session. I want to thank ASA once again for this platform and all the panelists for your insights. I'll now hand it over to Manisha.
Thank you so much, Sushant. It's now time to bring this interactive session to an end. Thank you so much, Sushant, for being an excellent moderator, and Lavanya, Moksh, Pranav, and Nitin for leading us through this engaging and stimulating session. Thank you all for being such an amazing audience. I'm sure you would have immensely benefited from the deliberations. We will also be emailing a summary of the deliberation and a link of the recording of this webinar. We have tried to answer as many as questions as possible, but still have some unanswered ones. Shall be replying to them over email. If you have any more queries, please reach out to manisha.sachdeva@asa.in. Once again, thank you all for joining us today. Have a great weekend. Thank you so much.
Thank you. Thank you, everyone.
Thank you.
Bye-bye.
Thank you. Bye-bye.